Good afternoon. Thanks for attending today. I'm Ken Kirschenbaum, and as you know, we present webinars to the alarm industry with the most knowledgeable people within our budget. And so we have Mitch and Dennis today. Today's webinar was actually Mitch's idea. Mitch is very, very involved in acquisition work, as well as consulting and the due diligence work and things like that. Dennis has a tremendous amount of experience in acquisition work, and the two of them are going to be really presenting today. I'm just hosting in a way, and I'm going to try not to talk too much. I was thinking a little bit, Dennis, today that you know, everyone accuses me of promoting contracts, and that's what I'm known for and everything. But I was really thinking, if I can come up with a product to grow hair like you have, I could really make a lot of money, and I'm going to look into that. We're going to have you tested, Dennis. Okay?
What product are you talking about?
Your hair.
Oh.
If I could get hair to grow like yours, I could promote that. I could certainly sell it to Mitch. That's for sure. All right. All right, everybody. These two guys are serious guys. They really have no sense of humor. So I'm going to turn you over to them right now. Mitch, you're all set to go?
Right. Thank you, Ken. And Dennis and I are ready. And this is about how to approach the selling process, but not necessarily when you're ready to sell, but right now, because someday you will be selling. And those of you around back in the 90s remember Dr. Laura Schlesinger, and she wrote a book called 10 Things Women Do to Mess Up Their Lives. And today's presentation is going to be 10 things that owners do to mess up their sale. And what we want to do today is address the things that owners do, sometimes inadvertently, that make it tougher to have their sale done. Now, you're fortunate that you have somebody as talented as Dennis on the call who can fix most of these things. But the best way to fix a lot of these things is not to have them happen in the first place. So
you're going to put me out of business.
So the first question that people ask me is, why worry about selling? And Dennis and I talked about this, and our answer is, you worked hard to build your business. Why not sell it for the best price and have time to reap the benefits? And so most people also tell me, I have a great business. Buyers will be standing in line. And that might be true, but you want to get the best price. And the best price may not always be the highest multiple. So you want to make sure that just because somebody's throwing a multiple at you, that they're not hidden things in the agreement or things that you've done that are going to reduce the net you walk away with. And Dennis is going to talk about that. And bottom line is, the contestant in this beauty contest with the fewest blemishes is going to win. So what you want to do is have the fewest blemishes. So number one is run your business like a business. It's important to be technical. It's good to have the technical skills to run your business, but I hear far too many people, and a lot of them on Ken's page, saying, I really don't care about the business aspect. I know how to do what I do, and that's all that matters. And what I've got to say is, nobody ever signed on to be a bookkeeper, and I understand that, but you've got to run your business like a business. And Dennis, you want to chip in a little bit on that and talk about some of the things you see?
Yeah, certainly. And, you know, to go back for a moment on the best price issue, I think you have to be aware that at least in the preliminary conversations, people throw out numbers, but when you get to the nitty gritty, there are a lot of things which impact that number. So even if they talk a high multiple, there are a lot of deducts that are going to show up. For instance, in the definition of RMR, how do you define RMR? And people will define it as anything, you know, excluding anything over, some of them try to do anything over 60 days outstanding. Other people more generally talk about anything over 90 days outstanding. Telephone lines and alarm net charges are usually backed out. You can try to resist it, but that's pretty tough this day and age. The most important area is your contracts, and I know we always tout Ken's standard contract, and they are very good and they're very accepted in due diligence, especially if your buyer needs bank financing, they're very acceptable. If you don't have good contracts, then you're going to have issues of how do you fix them and who pays for that, who pays for that. So those are all things that can reduce that very nice multiple because the RMR is shrinking. Issues about how do you convert if you have still 3G equipment out there, who pays for the conversion? How is that done? And usually a big reduction, depending again on the size of the company and how you bill, can be for the deferred revenue. So you really got to talk through all of those issues when you start addressing the LOI and terms and conditions so that that 40 multiple, which is great, by the time you get done, you might be down to a 36 or 35.
And Dennis, that brings us to the number two. And number two, after running your business, is really number one of the things you should have going into a sale, and that is your customer contracts, your monitoring agreements. Everything you do for your customers should be clear and it should be in writing. And I tell people the purpose of these monitoring agreements, these customer contracts, is to clearly state the expectations of all parties. And for my non-legal mind, and Dennis is going to expand a little bit on this, what the contract should say is what's being done. What are you doing for that customer? What's that customer doing for you? Who's paying? How much? What's happening? And also what's not being done. And by what's not being done, Dennis will talk a little bit about that too. The disclaimers: you're not an insurance company. You're not. If you're installing a break system, it's not a fire system. If you're depending on communication lines, you're not guaranteeing the communication lines. All these things that you're not doing should be on that contract. And who's doing it? Who are you? And why are you doing it? Who's it being done for? And Dennis will talk a little bit about issues of transferability and what you need to avoid there as far as who's doing it and who's it being done for. How long is it being done for? You need to have a clear term and it needs to automatically renew. And who pays? Obviously, the customer hopefully is the one that pays, and the person that signed the contract is paying. If somebody else is paying, you need to get them under contract too. And how much do they pay? You'll be amazed how many contracts we see in a transaction when nobody bothered to put any RMR in the contract. And yes, guys like Dennis can fix that, and guys like Dennis can talk their attorneys into accepting those contracts, but it causes confusion. And then what happens when things go wrong? If something doesn't happen, something doesn't work, something doesn't come about, what does the contract say about remedies? So Dennis, why don't you go through a little bit of this from the legal standpoint? My concern when I see these is making sure that we've got it from a deal standpoint. And one overriding thing I want to mention to you is when Dennis tells you all these things that he can do to fix things and what's out there, if the buyer won't accept the agreement, it really doesn't matter what the attorneys say. If the buyer doesn't accept the agreement, it's not going to get bought. And I've never in 25 years of doing due diligence seen one of the industry standard contracts, especially Ken's, not be accepted. And the contracts that Kirschenbaum puts out, if you're thinking about getting contracts and thinking about updating your contracts, are accepted coast to coast. The buyers accept them, the banks accept them, the lawyers accept them. So remember that. Dennis, why don't you add a little bit?
Okay, just I mean, the heart of the transaction is driven by the contracts, obviously by the RMR, but as it's represented in the contract. So very, very important to have good contracts. And as Mitch just said, Ken's contract, they cover everything from A to Z and then some beyond that. So, and they have gotten acceptance by people who do due diligence and by the banks. And the other thing that's nice about that is people who do the due diligence don't have to spend a lot of time reading the contract, because if it says it's Kirschenbaum and Kirschenbaum contract, they know it's fine unless something has been marked up. So it's very critical to have that. I mean, I had a client who was working very hard in building up his business in the fire alarm portion in New York City. And his view was he didn't want to have a contract because he didn't, quote unquote, kind of want to insult his customers and, ask them to sign 2-page documents and so forth. So he just did it all on proposals. And the thing I pointed out to him, that's very nice theoretically, but he's working very hard to create a business. And there's a difference between creating a business and creating value. And if you don't have the right contacts, you are not creating value, because buyers will back away, and certainly any buyer who needs bank financing will back away from that. So you can't overstate the need on the contact. And the good contacts, obviously the most significant thing is the limitation of liability clause and the indemnification clause. To me, and I think I'm probably in a minority view, to me, the indemnification clause is not as significant as the limitation clause. Because one of the problems with indemnification clause is, is the person who is indemnifying you, do they have the wherewithal to do it? But we'll leave that for another seminar. But the contact is going to talk about things, what is included in a warranty, what is not included in a warranty, who is responsible, or rather that the company is not responsible for the phone lines and the internet connection. The company is not responsible for police response. And it goes into what the customer is responsible for, to test the system regularly, to report problems with the system, to make sure that the user or users know how to operate the system. False alarms are payable, false alarm charges are payable by the customer. And it also defines what service you're getting. Probably the easiest way is some contacts have check-off boxes, so you can check off installation, service, monitoring, and others do it slightly differently. So, but the bottom line is, whatever contact form you have, it clearly has to have those principal provisions, which is limitation, indemnification, renewal, and as Mitch mentioned, renewal. But this day and age, I don't know if all states do, but certainly many states will only allow annual renewals, as opposed to in previous days, you had contracts renewing for 5 and 10 years and all of that. And in some states, and I don't even know if New York has it anymore, because now it's a 1-year renewal, but they had a whole process where if you renewed, you had to send the customer certified letters and get receipts and all of that, which, as far as I know, was only one company in New York City that actually did that, because that's a very large burden on people. Can't over-express the importance of limitation of liability. And I know your salespeople, I'm sure, get pushback, especially if they're dealing with businesses on that. But the fact is, there's a very good reason to have it, and it's been upheld by the courts. There was a small to mid-sized company in Connecticut that had a fire system in a very expensive house in a very upscale neighborhood of Greenwich. The loss was estimated at 20 million, which obviously exceeded anything he had in his excuse me for a moment, which was way beyond anything he had in coverage. So at first, the insurance company didn't realize about the limitation clause. And this gentleman was very upset he was going to lose his whole business. Well, ultimately, because we were able to lay out what the limitation clause does, and more importantly, where it's been accepted, which is nationwide as far as I know, is that he ultimately, which was covered by insurance, the insurance company paid about $600,000 to get him out of what was a $20 million litigation, which would have bankrupted him. So you can't underestimate the need for that. And one thing with that is, I think as a business, you've got to have a process about how changes are made to the contract, because you get a lot of pushback on limitation clauses. And salespeople sometimes have a different perspective, namely make the sale. But your perspective is slightly different. How do I preserve value? And so I think you've got to have an ability to look at any proposed changes to a contract, especially if they're to the limitation clause.
And Dennis, one thing I see from time to time is we did a transaction in Nebraska, very small town, the only alarm company in the town. The guy had about 500 customers, and he said, I really don't need contracts. I went to high school with most of my customers. I see them in the community. A lot of them belong to my church. They would never file a claim. And what I had to remind him was, one, the buyers were not going to be from his town and weren't going to know these people and weren't going to have that relationship. And two, if there is a claim, it's typically the insurance company that's asserting the claim, because the customer has filed a claim with the insurance company, and they certainly didn't go to your high school, and they certainly don't go to your church, and they certainly don't respect the relationship. And so you got to have contracts. There's very little chance of getting a transaction done without contracts. And not only contracts, good contracts. And this is really the most valuable asset you have in operating and selling that business, and you can't take shortcuts with it. You need to do it right. So getting on to number 3 is the form of entity. And this is one thing that less and less common, but I still run into it out there, and how you can trip yourself up having the wrong entity. And it would be an entire seminar to talk about this, but there are still a lot of companies out there that are C corporations or LLCs that are taxed as C corporations. And I started doing accounting back in the 70s when S corporations weren't very popular. And there's still a lot of old school CPAs that don't understand them, but bigger than anything else is a lot of accountants, a lot of tax practitioners, a lot of CPAs don't understand the security business. And they don't understand that you have this big intangible asset, which is your RMR, your monitoring agreements, that when you do go to sell them, are going to get taxed twice in a C corporation. And in states like California, that can mean the difference between paying 27% tax on the sale and paying 65% tax on the sale, which can pretty much eat up any value having your transaction. So you need to think about that, and you need to think about being the right entity. And if you do want to change, it's a 5-year process. So think about that way before you want to sell. And I have a lot of guys that call me and they say, we're not too worried because we're a sole proprietorship, or it's my brother-in-law and I, we're a general partnership. And they're correct. They're not going to run into the tax issues. But Dennis, I want you to talk a little bit about the legal implications of operating a company like an alarm company with, contracts or not, big liabilities, and not insulating yourself with some sort of form of entity like an LLC or a corporation.
As you said, if it's a sole proprietorship, you're on the hook for everything, right? So, I mean, obviously you have insurance, but that obviously is also reflected in the insurance rates that you get charged, and if they have any deductible. So, I would not recommend a sole proprietorship. I'm not sure why anybody would do that this day and age. Partnerships have their own challenges, namely the other partner. You got to see how you set that up. A lot of partnerships are set up 50-50, and that is fine while everybody is copacetic and friendly and plays golf together, or tennis, depending. But it's clear that that can lead to a lot of issues. And then you also have to provide what happens if one of the partners becomes deceased. Now, maybe you wind up with the spouse in your business and so forth. So there are a lot of issues there. So from a tax perspective and from a practical perspective, I would see no reason why you wouldn't incorporate as an S corporation and get the tax benefits, but also get the liability protection, which goes with a corporate structure.
Now, number 4, and I'm putting my broker hat on, I put my accountant hat on here, is know your RMR. Unless you're selling a true systems integration company that doesn't have much as far as recurring revenue, if you're the typical security or fire monitoring company, the principal asset in your transaction is going to be RMR. It may value differently based on the structure of your company, but you'll be dealing with RMR and value of RMR. And RMR means recurring monthly revenue. And so let's look at that recurring. It happens month after month. So if you have customers you bill quarterly and you bill every calendar quarter you bill out $90,000 and you don't bill again until 3 months later, you're billing out $90,000, but that's $30,000 of recurring revenue. Only 1/3 of that is the revenue that belongs to that month because it's monthly revenue. It's not annual revenue. It's not quarterly revenue. It's monthly revenue. So understand that. And I can't tell you how many times somebody calls me and asks me what their RMR is, and they'll say, well, in January it's 45,000, but in February it's 12,000, and in March it's 68,000. No, it's the same amount month after month. You just bill it differently. You've got to understand your monthly, and it also doesn't mean that your annual monitoring revenue is $600,000. No, it's $50,000 of RMR. So remember that. And RMR value at the end of the day is based upon cash flow. It's the amount of cash that is available to the company after they pay all the expenses associated with monitoring that RMR, whether it's central station fees, whether it's radios, whether it's additional services, whatever. It's the cash flow. And when the large buyers, when the institutional buyers and some of the regional buyers look at what they're willing to pay, they do something called a discounted cash flow analysis. They look at your RMR, they look at your costs, and they look at your attrition rate. And they say, how long is the average account going to last? And how much net cash is it going to provide? And they discount that back at a return factor. And they say, this is what the value is. And that's where you hear about multiples such as 28 times or 38 times or 42 times or 57 times. That is what their cash flow analysis results in. The larger buyers use that for the basis, for a starting point for their value. And when you see smaller buyers that don't do this, they're just mimicking, they're just looking at what the larger buyers are paying and using that for a number. Different companies will have different values based on how quickly their accounts charge off and how much margin there is in the accounts. So when you call us and you say, what kind of multiple is my company worth? Or when I'm doing evaluation for a divorce or partner dispute or the IRS or anybody, I'm going to want to find out how much are you charging for monitoring? What does it cost you to do that monitoring? What's your attrition rate? All those things enter into the value. So you really can't compare any two companies. You can get a general idea, but they all have different cash flow values and they all have different numbers. But at the end of the day, when you're valuing RMR, attrition is king. And what I mean by that is how quickly your customers are canceling is going to be the biggest determinant of the value of your company. A company that is experiencing 7% attrition is much more valuable than a company that's experiencing 14% attrition, and incredibly more valuable than a company that's experiencing 22% attrition. So it's very important to track your attrition. And I don't mean just saying how many accounts canceled last month and dividing that by how much RMR you have and multiplying it by 12. You need to know why your customers are canceling and what is causing the cancel and what are the factors leading to them canceling, because as you get ready to sell and even operating your business on a day-to-day basis, you need to know if there's anything that you are doing that's causing your account base to cancel. And so buyers look at that, and when they're paying the premium prices you see in some of the trade journals, they're looking at companies that are well managed and doing a good job with their attrition. So remember that's very critical. And I also want to clear up one other misconception about gross attrition versus net attrition. Gross attrition is your total cancels in a month. It's not offset by how many new accounts that were customers not known to you put on. So if last month you put on 110 customers, but you lost 100 customers, that doesn't mean that your attrition rate is negative. That doesn't mean that you don't have attrition. It means that you lost that many customers and there was a cost probably associated with putting them on, or you had to charge them to do the install. That does not offset it. When you hear the word net attrition is what's offset by what the users define, which is typically what we call rehooks, which is if you were able to get the new owner at the same location to subscribe to your service, that counts against attrition and results in a lower number because that's net attrition. So you're able to, for minimal expense, reconnect that customer. Or if you get the customer, if they move across town and reconnect with you, again, that can count against your net attrition, make your net attrition number look a little bit better. So it's also important to manage that. When customers move and reconnect, it's important to stay in touch with them. When new people move into your old customers' locations, it's important to stay in touch with them. And if you're not doing that now, it's very critical. Dennis, do you have anything you want to say on attrition?
Well, just that, yeah, what you said sort of covered the area, but attrition is clearly the driving force when you get to negotiating the contract. If you have a good re-sign policy all along, so that if somebody cancels, you follow up and then sign the new person who moved into the business or the house. That's very helpful because one of the things we always try to do in the negotiations is to get the seller credit against cancellations for re-signs within 30, 60, 90 days, depending on the negotiation after the cancellation. So that's very important. But just having good attrition records is a big factor. Just to go back for a moment on the corporate structure, even if you have a corporate entity, because I mentioned you can have problems with partners. On corporate entities, you don't, some people sometimes, to reward some of their top managers, will give them some shares of stock in a corporate entity. That's not a good way to go, because then when you try to sell, you may have to get those people, even though they're minority holders, that may have to sign off on the contract that is negotiated, and you don't really want them in the negotiation process. So if you feel very altruistic and you want to reward people appropriately, instead of giving them stock in the company, give them some kind of cash bonus. That way you don't have to deal with it down the road.
Absolutely.
Which is with an S Corp, right? You mentioned, so I think anybody who's still a C Corp may want to talk to you about how they convert to S Corp, because you do get partial credits, right? As you're waiting to hit the 5-year mark.
Actually, you don't. It's you have to go all the way through to the 5-year mark. But one thing too that I hear a lot of times with owners, and it's a good you touched on that subject, Dennis, was giving stock to your employees, especially in an S corp. If there is any residual cash, you've got to pay that out to them, or at least allocate earnings to them at the end of the year, and they've got to pay tax on it, which can be a real mess, especially if you want to keep the money in the company to run the business. You have employees looking for their 5%. When people call me and want to set up these plans, I almost always say, give them a bonus, give them a bonus, give them a bonus. You don't want to have stockholders in your business that you don't need to have. And in some situations, you can end up messing up your S corporation election and be automatically have it revoked and be automatically converted back to a C corporation without even realizing it. So be very careful about giving equity in an S corporation to anybody. So number 5 on the list.
Before you move on, Mitch, first of all, I agree with you, and I discourage clients for giving out stock unless it's in connection with a planned buyout, which is usually with relatives or very long-term employees. But you guys have 2 attrition questions that I want to read so that you don't miss them. And they want the first one is they want to put this presentation in perspective as to how many accounts, a starting point, does this apply? In other words, he thinks that apparently this program does not apply to small firms below 1,000 accounts. Does it? The answer is yes, it does, because plenty of, if you're selling 100 accounts or you're selling 400 accounts, the buyer still wants to know what's your attrition rate. If you have 100 accounts, you may have a lower attrition rate because you have a smaller client base to start. Maybe you're more attentive, maybe they're long-term, but this program certainly applies no matter what size account you have. This one I'll throw out to you guys. How attrition would be applied to PERS accounts? So they want to know about PERS accounts. I guess you could also throw in the DIY monitoring accounts with it.
PERS accounts are a different base, Ken, and we have
the first question. I would tell you, if you have a small company, much more critical your attrition rate, because you're starting off with a very small base. So a buyer is going to be much more focused on how many accounts you're losing. So if you only have 200 accounts, he's going to really focus on that. So I think it's the bigger the company, the easier it is to have a 6 or 7 or 8%, which is a very good rate, attrition rate. Whereas if you have 200 accounts and you have that rate, that may not be so great. I will leave it to Mitch. On the PERS, I would take a pass. I'm not, because I know they work differently I don't think they view attrition the way you do on the regular alarm side, because they refurbish the equipment and all of that.
And Kim, PERS is a different beast. And, in 25 years of dealing with the typical Bergen Fire accounts, we have a client that we got about 2.5 years ago that has a bank loan, and they're a very, very good, very successful PERS company. But the first couple of months that we had them, their attrition was topping 25 to 30%. And I looked at their reports, they're sending out to their bank, and I almost had a heart attack. And then I realized they were growing at 35 or 40% because a lot of these patients are unfortunately passing away. But the centers and the areas and the places they were dealing with that were generating those customers were bringing them new customers faster than the customers were canceling. And the bank was aware of that, and they saw that, and a buyer would be aware of that and understand that a PERS account doesn't typically last 8 years. A PERS account lasts 1.5 years or 2 years if you're lucky. But fortunately, with a PERS account, with most of the systems, there's not a lot of installation costs. You just get the system back, you clean it up, and you ship it back out again. So PERS is a whole different beast. You've got to look at month over month growth and make sure that that you really can't use that net attrition computation. Some people say, well, I added this many, but I lost that many. But you do look at month after month growth and make sure the company's still growing. And you take that into a factor, but you really can't apply the typical Bergen Fire attrition standards to a PERS account.
The next question is, what is the average alarm company's attrition for larger companies?
Well, then the answer to that is, what's the average alarm company? A fire company would typically have a much lower attrition rate than a company that dealt with a mass market type account or a DIY type account where the account base is more volatile. Obviously the best type of account as far as attrition is a fire account with a very expensive installation and a tough AHJ that's requiring them to have that account. They've got to have it, and they use it every day. When you start getting into residential accounts and light commercial accounts, the more you can make the customer use that system, usually the lower your attrition rate is, and the more you can provide a service and quality of the customer, the lower your attrition rate is. But to make a broad statement, what's a good attrition rate? I don't know. I would say for a fire or light commercial, between 7 and 10% is what I would expect the attrition to be. For the typical residential company, between 8 and 12%. Then when you get into mass market and DIY, I've seen as high as 12 to 15, maybe even 16% being acceptable.
Yeah, I would agree with that. I think the standard that had been accepted, at least for a long time in the industry, was 10 to 12% is kind of the average that you see, which is still acceptable. A good company is down to 6 or 8%, and therefore could demand a higher multiple. Once you get above 12%, you're going to get dinged on what people are going to be willing to pay for.
Let me ask you this, and I actually just thought of it as an issue. Of course, attrition is something that you look at, that a buyer wants to look at. Attrition is something that any company wants to look at while they're operating also. But isn't it important to also look at the growth that a company has, the whether or not, despite attrition, you're still showing growth month after month, year after year, and your RMR is on an uptick constantly? That, it seems to me, that would be an important issue when evaluating a company, especially if the buyer believed that it could continue the same sale methods and have the same success with sales after it takes over the company.
But there are other issues there. If you have a high attrition rate, even if you overcome it with additional sales, and then I would question how those sales are made, because you're talking about a churn here. If you have a high attrition rate, that bespeaks that there are problems with what you're selling, how you're servicing. So I think there are a lot of issues there. The fact that you're growing it is interesting, but you got to understand why you're doing all those great sales, but more importantly, why you're losing so many. And that, to me, bespeaks an issue with your operation.
And Kim, when I see growth in a company, I look for it to be responsible, managed growth, and it's not uncommon for a company to decide they want to sell and they want to build their RMR and engage in something that's fairly drastic, like selling, going from a 3295 monitoring to a 1495 monitoring, and getting as many customers as they can. Their profitability starts to go down, and sometimes they'll do what they call the AT&T and the cable company method, and they'll offer a teaser rate out there for $13, $14, $15 a month. And then when the customer's not looking, try to pump it up to 25 or 30, which causes huge spikes in attrition down the road. So when we're looking at an analysis and looking at a company's RMR, we'll typically look at the mean monitoring rate. So the mean is the average rate, and then the median rate, which is the number that occurs right in the middle. And we'll go back and look 2 years ago and see what those numbers were too. And if we see those numbers start creeping down, especially the median's creeping down pretty drastically, we know that they're offering some sort of low-cost program and that it could result down the road in some higher attrition. So yes, it is good to be growing. And yes, it is good to have year-over-year growth, and 10% is a pretty good number. But when a company's got 25 or 30 or 40% growth, like Dennis said, there could be hidden dangers in that.
I think Victor Harding put in a comment, in his experience, the average rate on the account is as important as the attrition rate. Average rate, Victor, do you mean the number of accounts or the price of an account? There is another question I want to get. I don't know whether we can answer this one. How long does a customer usually last?
A customer that usually lasts.
Well, you could ask AFA that question. They'll tell you 100 years. So,
I've seen some studies out there from some of the larger companies looking at a diverse account base, and a number I'm fairly confident using for a midpoint for all security companies is 8 years. Fire accounts, like commercial accounts, usually tend to last longer. High-end residential accounts usually tend to last longer. Mass market accounts and simple residential accounts tend to last shorter, but you should be shooting to have your average customer last 8 years.
Yeah, I would agree. In years past, a lot of the big companies were using a life of some 17 years, obviously for tax purposes and depreciation, but I think they were challenged a lot on that. So they finally came down to the age that Mitch is talking about. 7, 8 years is a good number.
Well, what Dennis is alluding to is the larger publicly held companies are using the tax life, which the IRS has assigned, which is 15 years for accounts. And the SEC came out and said, we all know that the tax law is very rarely reflective of any kind of economic reality. It's a social wealth redistribution program. You guys have to change your ways. And so the big companies, ADT, Monotronics, Protection One, all the Brinks, all the larger companies at the time engaged what they called valuation firms to do lifing studies. And they would look at pools of accounts and look at how long they lasted. And every one I saw and every one I've seen in the last 20 years has come in between 8 and 8.5 years for a typically average, well-distributed company. And so I've got no problem using that number.
A wholesaler, a central station, wants to know whether attrition is treated differently, and it is, because wholesale central stations, for example, have a much higher attrition rate typically than a traditional alarm company, and that's because it's the dealers that are turning these accounts over. Not necessarily. I had one central station once that told me a long time ago that they had an attrition rate of 25% that turnover, and he was constantly turning over his accounts. Kept the same number, but kept turning over the accounts. So that's how it would work with a central station.
I think that's a question for another webinar, and probably an entire webinar, is how to value central station and central station value issues. But we're on number 5 of our 10 ways, and we're getting pretty far into this. So if it's okay, unless you got some really burning questions, Ken, I want to address some of these other issues that I think are important for people to know when they're
I'm
getting
just
ready to
reading the
sell.
question. I'm reading the questions off now. That's all. And we do have. Here's one that Dennis won't answer. Is it true Dennis got 52 times for security link? Well, he's not going to answer that one. And trust me, Dennis didn't get the 52 times. If that's what he
did. I negotiated the deal.
Yeah. Okay. I know companies like Rapid and Cops need 3 weeks out of 4 to cover the attrition, which results in a net gain of 1 week connections. Okay, I have no idea whether that's true or not, and we're not going to deal with that. How many accounts that we are well over 20, we have many accounts over 20 years. Good, you better upgrade those systems. Is this considered a liability to buyers because they are so old, especially with residential? Yeah, probably. Good point. But you guys can address that if you want.
Yeah, I mean,
Yeah.
and that's one of the things we're going to get into if we can get back to our
Okay,
presentation
go ahead.
is keeping
Go
equipment current. Yeah.
Go ahead.
You know, the next thing is number 5, and that's address operational issues. And we'll go through this quickly, and hopefully Dennis will give his knowledge quickly too. But I still run into people with phone line issues, companies that don't understand that if you're going to sell, it's very important to have all your panels reporting on phone lines that you either own or control, that you can easily pull from the station and send to the buyer's new station. Otherwise, you create huge complications. Communications issues with communicators, issues with old panels, issues with old technology. Right now, 3G radios are a big impediment to sales. And I have people calling me all the time that think that if they just bury their head in the sand, the 3G issues are going to go away. And people call this a sunset issue, which is really a misnomer. Sunset is when the government is mandating that a technology change, like the analog sunset a few years back, where the FCC was in control. 2G and 3G are in the hands of 1 or 2 providers that are saying, we don't see a business reason providing this service anymore. And whenever we want, we're going to turn it off. And the government and everybody else and all the lawyers in the world aren't going to do anything. And if you don't address that, not only do you have an issue with your customers communicating with you, you have an unsellable account. We talked about this a little bit last week. I have seen some buyers willing to go out and replace those radios, but more and more buyers are saying, hey, this is coming too quickly. We've got too much liability. We're not buying any more 3G accounts. And it really bothers me sometimes when I hear a seller telling me, well, I still have a 2G account. It went dead 3 years ago, but the customer won't respond to me. So we're still monitoring them, but we know that they can't send a signal. Whether that's legal or not, that bothers me that an operator would operate that way and know that they're not providing the service to the customer they're billing them for. There are lots of other issues. I'll let Dennis talk about some of them, but you need to be aware of issues that are going to make your company less marketable and develop a plan to start dealing with them now. Dennis, what else do you want to add as far? Oh, and one other thing before Dennis gets on, knowing to cancel customers out of your central station when they cancel with you is very critical. I can't tell you how many times we go back to check somebody's attrition numbers doing a due diligence, and we look at their central station bill and they haven't deleted an account in 6 months, and we ask them why, and they say we haven't had time. So what you're telling me is that you are continuing to pay that central station $3, $4, $5 a month for monitoring that the customer is no longer paying you for, and you're not monitoring the customer anymore. You don't even have the discipline to go back and cancel those guys out of your station. How do we have any faith at all in the records you're showing to our buyer? But go ahead, Dennis.
On that last issue, there's a huge liability exposure too. If a customer is canceled and you keep monitoring, when a customer cancels, you should have a date that you both agree on when you're going to stop monitoring. Usually customers give you some notice, and you should be sending a notice back advising them that as of 5 p.m. on X date, you're going to terminate the monitoring and make sure the central station will terminate on that date, because you don't want them to keep monitoring after that date, because now you have a canceled contract with monitoring, and so you have a huge exposure area there for sure. I think it's very important in terms of, and communications issues I deal with a little differently, is, to have good communications between the central station and the alarm dealer so that you're aware of when there are customer issues with service, the system isn't working and so forth, because that obviously is going to impact your cancellation rate. Also with your monitoring company, it's very important because people have tended to just sign off their contracts, and I think they all have contracts these days. But one of the things, and I don't know that it's still very popular, but several years ago, all of the third-party, or a lot of the third-party monitoring companies had a right of first refusal in their contract, and it was amazing how many local alarm companies signed off on that. That you never want to give anybody a right of first refusal on your business, because that devalues the business. So very few buyers who will come in on the understanding that somebody else can make a competitive bid. They're not, that's going to turn them off right at the start. So it's very important to look at that agreement. The other thing is, some of the, I guess, better operated companies, monitoring companies, will also require your customer to sign a contract. Won't specify the amount or anything like that, but it's really a liability protective cover for them, because if there's no contractual relationship with them, they obviously can't or in the instances use the limitation of liability clause. But it also adds further protection for you. So I think when you have a third party station, especially the bigger ones, I think you need to focus on whether they have that kind of contract and if they are implementing it, because it protects not only them, but it helps protect you as well. I see we're on number 6, so we'll leave it at that.
I want to go into tax issues, and not just tax issues that happen with capital gains and things at the sale, but not understanding the tax environment you operate your business in. We worked recently on a situation where the seller was not paying their sales tax currently, and they weren't paying it at all for a while. It turned up during the due diligence, and we found out that they'd reached an agreement with the state and were paying that off over time. And there's something you get in most states called a clearance letter, which comes from the state controller in that state, that says that they're clear of any tax liability and they're ready to move on. And in this situation, the lawyer said, well, we know that they still owe $70,000 in taxes to the state, and we'll just get a clearance letter and get them to pay the $70,000 at the closing, will be okay. But what the attorneys didn't understand, and what we saw, was that this settlement had been reached about 1.5 years ago. And from what we could tell, they were still not paying taxes to the state. And so I advised the attorneys, and I was right. When they sent for the clearance letter, the state usually has 30 days to respond, and the state responded in about a week. And they said, we're not going to give you a clearance letter because we don't think these guys are paying their taxes, and they were right. And we want to go out there and do another audit. Well, that was 8 weeks ago. The lockdown hit. Their auditors aren't going anywhere. So it's delayed our closing by probably 4, 5, 6 months while we wait for this audit to happen. Make sure you're paying your taxes, make sure you can show you're paying your taxes, and make sure you can show the buyer that that's happening, because in addition to creating a liability, we start wondering about the quality of the books we're seeing, about the profitability of the company when they're having to take money that they're collecting from their customers and using it to pay bills and make payroll. And lack of knowledge about taxes. The sales tax scenario in this industry is very convoluted and very complicated, and we spend thousands of dollars every year trying to understand sales tax. And it's not uncommon in a transaction to run into a situation where the seller did not know that a service, especially monitoring, was taxable. And in Texas, burglar monitoring is taxable. And we ran into a situation, we represented the buyer, where the seller had not been paying sales tax or collecting sales tax, and the buyer's attorneys felt comfortable about letting that go because the controller never visited them. But we had to look at the situation that a buyer did understand that it was taxable and did intend to charge and pay sales tax. And then what do? Do you raise the customer's monitoring rates after the transaction to cover that sales tax, or do you discount them and include the sales tax in the invoice, which means the RMR went down. And in this case, we discounted them by 8.25% and left them at the same monitoring rates, but that reduced the seller's RMR. So it's very important that you know the tax environment for your business and that whoever's doing your taxes does understand that. Dennis, do you have anything else to throw into that, or you want to move on to the next thing?
Yeah, just that, especially the focus on sales tax. And as I mentioned to you, I believe in New York, if the taxing authority doesn't respond in 30 days, then you as the buyer are no longer liable if there's outstanding taxes. And that may be unique, but clearly you need to do a search, and you also need to have very strong reps and warranties in the purchase agreement that deals with the fact that all taxes are paid, because some of the taxing authorities, especially if the number is big enough, will try to go after a buyer on a successor in interest theory, which is another good reason why you don't really want to buy stock. You want to do a purely asset deal.
And Dennis, the key word there on that clearance letter is respond. And the state usually will respond in 30 days. And typically what they do is they look up the taxpayer, the seller, and they look to see if they've had any history with them. If they haven't had any history with them, they're more than likely to say, okay, we're okay. We think they're paying their taxes. Everything's okay. If they've had history with this customer or with this taxpayer, like we had with the seller that we dealt with a few months ago, they're going to say, hey, wait a second, this guy has perennially been an issue. We've been out to see him a couple of times and found problems. We are going to respond, but our response is going to be, we ain't giving you a clearance letter. And so be aware of that. If you're running your business and getting ready to sell, if you're having issues with your taxing authorities, they may not be real excited about giving you any kind of clearance or giving you any kind of letter, and may in fact come out and audit you again. So bottom line is, if you're getting ready to sell or thinking about getting ready to sell or just running your business, pay your taxes and pay them right and stay current. The next thing, this is really Dennis's area, is legal issues. And the only thing I will say is that I run into these issues sometimes where people have failed to get licenses, failed to maintain insurance, failed to maintain their corporate standing, and misclassified their employees. And it creates huge issues in the sale. But Dennis, go ahead and talk about, you see a lot of this when you're getting ready to do the purchase agreement and when you're looking at results of due diligence. And I know you can get through almost every single one of these, but how much trouble it creates.
Well, any of these issues, because you're told at the beginning of the process it's only going to take 3 weeks or something. Any of these issues, when they pop up, they take time to resolve. Two things: they take time, and they also take further negotiations, which can impact the sales price or the purchase price, depending how you look at it. Obviously, employee misclassification claims and litigation, if they exist, then you've got to, as an attorney for a buyer, you've got to research them. Depending on the case, most of them probably covered by insurance. You need some letter from the insurance company about the status, so you can make some assessment that it's covered by insurance, that you're not going to get hit at the end of the process as some successor to the business, that you're going to be liable for anything. Licensing issues come up often, especially when you're in a state that has a lot of local licensing. People don't always focus on that, probably for very good reasons, that they can't be bothered with it. And lots of times the localities don't do anything unless some issue arises, somebody complains. But if you have a buyer who does very good due diligence and they expect you to be licensed in all jurisdictions, obviously that can create problems, because licensing, as you know, can take time. So that slows down the problem. Insurance issues are, what kind of coverage you have. I mean, it's amazing to me, there's still a lot of companies that provide monitoring, whether directly or through a third party, that don't have errors and omissions insurance, because that's the type of coverage. You might have general business coverage, but you need the errors and omissions to cover the situation of a problem on the transmission of the monitoring signal. Obviously corporate standing can be an issue if and again, it will delay things because if you haven't filed most states require annual reports, which are really not very involved, but have to be filed. So if you haven't filed it, then when you go for a certificate of good standing, which is usually required in any transaction or any meaningful transaction, now all of a sudden you got to file those. So that takes time again. Indemnification issues, you can spend a lot of time arguing about those. There's some people who don't think a seller should indemnify at all, but it's fairly standard that a buyer wants some kind of indemnification just in case some of the representations and warranties were not accurate, such as taxes and a few other significant things. But those are issues that get negotiated out. Usually try to get a carve out so that a seller isn't faced with nickel and dime claims. So you set a basket, and then at the other end, you set some kind of limit as to how much indemnification is there. And you always have time limits, because on the operational side, if a buyer can't figure out problems with the operation in 1 year, either they're not there or shame on him. So try to limit the indemnification for operational issues to 12, max 18 months. And then some of the bigger issues, obviously, take a look at statute of limitation for taxes. Ford has no limitation, but not likely to appear too often. Non-compete issues, again, require negotiations. If you're the seller and you're just going to retire and go fishing, not such a big issue. But if you're a seller who's still looking to do other things in the industry, maybe go work for an equipment manufacturer, something like that, or be a general consultant to the industry, you've got to make sure that those things are carved out of your non-competes. Non-competes should also be geared in the number of years to the size of the transaction. So if somebody's getting only 200,000 for their company, they shouldn't have to look at a 7-year non-compete. On the other hand, if they're getting 7 million, maybe 7 years is not that unrealistic. And then you got to look at the geographic area to which it applies. Now, California is somewhat unique. California, you can only have a non-compete in the counties in which the company actually did business. And on the non-compete issue, for valuation purposes, from a seller's perspective, you want to make it a nominal consideration because it's ordinary income, even though it's an asset to the buyer, but to the seller, it's ordinary income. So you don't want to have a large valuation there because obviously the tax implications to that. And then the other things that can pop up, going back to licenses, if somebody doesn't have licenses as needed, then you get questions of you need a license holder agreement, and maybe the owner who's selling has a license, is willing to be the license holder issue. And that's how you resolve some of those issues. And I think we're on to number 8.
Yep. And we're running out of time. So the last thing I want to talk about, we'll skip 9 and 10, is number 8, books and records and copies of agreements. You should have all your tax returns, have all your reports, but one thing that amazes me that people don't have is a copy of their agreement between their company and their central station that says the term and all the other things like Dennis talked about, rights of first refusal. But there are a lot of people that are still under contract with their central station for 2.5 years, and they're not going to be able to get out of that contract very easily. And they're getting ready to sell these accounts to somebody that may be at a different station. Make sure you're aware of the terms of your central station. The last thing you want to do is get a month into the sale process and find out your central station agreement gets auto renewed for another year. And I'll leave Dennis to comment on the other stuff. And if there are other comments, Ken, if you got some questions building up, we can try to get those asked before we run out of time.
Okay. I mean, I think on the central station, you have to have a copy of the contract because no buyer is going to buy unless they see a copy of that contract. in most cases, and what we've always done in our deals is we get a assignment from the central station company. And except in one rare case, they've all been very willing to accept the new buyer and continue monitoring until, if they're going to move them, until they move the accounts on a month-to-month basis, keeping it at the same pricing. But you've got to focus on that and look at what the contract says. And certainly if it has a right of first refusal, that obviously comes out of there in the document that you provide. On the leases and other agreements, you should have copies of all of them. You should know the terms. And if you're thinking about selling, maybe you can renegotiate some of them to shorter terms, because if a buyer is going to fold in the operation into his, he doesn't want to get locked into long-term copier service agreements and all of that. And the other thing is, there are a lot of questions which arise about how you shut down the operation, or how the buyer is going to shut down the operation. That can lead to a lot of negotiations on things like employee accrued vacation and so forth. But I think we're running out of time. So anyway, there are lots of issues around books and records. The better the books and records, the faster the due diligence, the less questions, the less delay in getting a deal done. Mitch, back to you.
Yeah, Ken, we'll see if we build up any questions you want to try to squeeze in before we run out of time here. Did we lose
Now,
Ken?
while we're waiting for that, one other thing.
Here I am. Well, here's the problem, Mitch. I keep getting in the question column, tell Mitch to keep going.
Okay. Well, we can keep going. I'm glad to put 9 and 10 back up. So
I told my friend Steve we're going to charge him for overtime. I don't think he believed me though. One here says they want you to address. I'm not sure what the question was. Interested in the profitability side, and that's one issue. Let me give you a few. Can you at least show us number 9 and 10? I blocked from my business, and I would appreciate the full webinar. Oh, okay. So you're attending, and you want the full webinar. Okay. Well, we charge extra for the full webinar, but we're gonna see what we can do. We'll accommodate you. If people don't leave, we can stay and try. And can a buyer pick and choose contracts they will accept and will not from amount billed? Buyers can do whatever they want if the seller agrees to it. So
there's
anyway,
an art to it, and the art to having a good lawyer and a good broker is to make the buyer buy as many contracts as possible to say, we're going to find another buyer. So you're ejecting another moving part of the transaction when you have to start picking and choosing which contracts you have. Bottom line is, if you have uniform contracts that are all enforceable and marketable, you don't have that issue.
Yeah, and even if you do, if you have a reasonable buyer, it depends how many unacceptable contracts you have. If it's a limited number, there are ways to deal with that in the purchase and sale agreement. Obviously, if it's a high percentage, then yeah, buyers may not want to pay, at which point sellers will probably not want to sell.
And in 25 years of doing this, one thing I can tell you is I've never run into a buyer that didn't want to buy every agreement they possibly could. And nobody wants to exclude contracts just for the sake of excluding contracts. But if you make it so that they can't accept them, and you make it so that they're not tenable, then you're going to end up not being able to sell all your customers, and you're going to get a lower price. Ken, you want to, any more questions?
No more questions. Why don't you move on to 10 and
okay.
Let's get ready to...
Number 9 is one thing I hear from a lot of guys is, I've got a really profitable company and I think I should be valued on more than just multiples, and pay me a multiple of EBITDA. Well, what you have, if you have RMR, is a very profitable part of your business that is probably generating earnings or cash at 80 to 85% margins. Nothing else you do in your business is going to generate that kind of margin, which is why RMR sells for these such high multiples. And so what we do when somebody's getting ready to sell, what we do when we're doing evaluation is do a steady state cash flow, which means if you did nothing at all but monitor your customers and service them, would you make more money than you're making today? And we come up with a number. Then we do what is called adjusted EBITDA or add backs, and we add back the expenses in your business that really aren't related to running the business. The the owner's salaries, the owner's Cadillac Escalade, the exorbitant trips and stuff like that may be legitimate business expenses but don't have to continue to happen. Then if after we take out the earnings from the RMR, if the business still shows EBITDA, earnings before interest, taxes, depreciation, amortization, then yes, you do have a business that generates some cash over and above that, and we try to get a payment for it. But in most cases, you will find that you are not making as much money as you think you are, and you're using some of your RMR to generate your growth. And if it's over an acceptable multiple, 18 to 24 times the RMR you're putting on, you may not see any additional value from that EBITDA. Dennis, do you have anything to add, or you want to move on to number 10?
A quick comment on the adjusted EBITDA, especially with a knowledgeable buyer. The buyer is looking for some of those adjustments like the Cadillac and the yacht and all of that as a plus on his side of the equation, which is why he can pay you the 40 multiple. So
Right.
whether you're going to get full credit for that becomes a subject of negotiation, because buyers expect to receive at least part of that adjustment to help them get up to the multiple that you're looking for.
True. Okay, and then the last thing that I run into from time to time that companies need to understand, this is more of an operational thing to start thinking about today, is lack of focus. Be careful with getting into areas that you're not comfortable in. If you're a fire company, be careful about not getting into DIY residential, not getting into PERS. Be careful about expanding your geography to someplace ridiculous. Don't put on a bunch of accounts 250 miles away from where you are, because when a buyer looks at that, they're going to say, how are we going to make those service calls? How are we going to deal with that? One thing that I'll let Dennis talk a little bit more about is barter agreements. Be very careful about getting into barter agreements with customers where you're trading them services for something that they're giving to you, because buyers may not be able to avail themselves of those agreements. And be very, very careful of generous service agreements, free service or service contracts where you're charging $1 a month or something like that, where the expense of providing that service is way more than what you're charging. Because a good buyer, if we're doing due diligence for a buyer, we're going to go back and subtract that out of your RMR. And well-run companies have fewer issues in due diligence, and less items which must be negotiated out with powerhouse guys like Ken and Dennis, and you'll end up running up much lower legal fees. And believe me, Ken and Dennis have plenty to do without arguing about every single line of your purchase agreement and all the things that you've done wrong. And you'll get a faster transaction, a cleaner transaction. That was number 10. And Dennis, let you add whatever else you want to, and see if we got any more questions.
Generous service agreements, not unusual for sellers, to get free monitoring and so forth. And depends how many free people they want, should usually be kept to the buyer and maybe his favorite niece and nephew. But if it continues and you agree to that, a couple of prerequisites. The first is you've got to get a signed contract, because a lot of these relatives don't have contracts. You need a contract if you're going to continue the service. And as Mitch said, I'm not sure you really want to continue it at $1, even though you might do it at a modest price. And more importantly, you also got to specify what they're getting free. Is it monitoring, service, additional installation? So it's not just sign the standard contract. It's got to be limited to what this quote unquote free or very reduced service encompasses.
We did a due diligence for a guy with 4,000 accounts, about 120,000 of RMR. And his agreements allowed him to charge trip charges and T&M for service calls. But we looked at his service revenue and he had almost nothing. He had about $2,000-3,000 of service revenue for this entire 4,000 account base. And what it turned out was he just regularly did free service. He never bothered to charge. And so the buyer went back and said, look, that's costing you $5 to $7 a month per customer, and we're going to deduct that from your RMR. So we ended up with a $28,000 deduction from his RMR, and there really wasn't much you could do about it, because they didn't want to continue to provide that service for free. And even though the contract allowed them to, the customer expectation was that that service call was going to be free. So be very careful about backing yourself into that situation when you're thinking of selling.
Okay, I'm trying to time my pizza bites in between, when I have to ask another question. We have 2 more questions, and then that's it. We're going to start with this one. In terms of attrition, if you have a customer who has several monitoring items, such as fire, video, security, how do you treat the attrition if they cancel one of the one item of monitoring? For example, security. That's a softball question. Go ahead, guys.
I mean, it depends on what they're canceling. If they're canceling additional services like alarm.com or something like that, it's attrition, and it counts against their attrition. But if it's just one customer, who cares? If it's a group of customers who seem to be canceling this area of accounts, I would still count as attrition, but I would break that out and explain that to the buyer. If they're
what they're saying is what they're saying is one customer with multiple services, and they cancel one of the services.
Yeah,
so what really counts is the RMR. That's what we're looking at, the RMR.
Yeah. But remember
Yes.
too that radios and service agreements and stuff like that don't have quite the margins that monitoring have. So you really want to track that stuff separately and track that attrition separately, so that you are, because it's probably going to get bought at a lower multiple. So if you're going to take it out for attrition, you want to take it out at a lower multiple when you're looking at your valuation.
But the question also some people have a unique way of counting cancellations, and they do it based on units. So if a customer cancels, that's one cancellation, even though there's a distinction between a $5 cancellation and a $1,000 cancellation. So if you don't do it based on RMR, you distort things. And if a customer has contracts for different services and he cancels one of them, that's a cancellation, even though he has other accounts that still are with you. It's still a reduction in RMR, and that's really the basis of what the cancellation calculation should be all about.
If you're, and Dennis is correct, if you're counting attrition based on units, that's nice to know, but as far as computing your attrition rate, it's wrong. Attrition is RMR over RMR, not units over units, because like Dennis said, a $1,000 a month customer would be a lot worse having canceled than a $30 a month customer.
Well, here's the last question we're going to have. A clean, large company with 60,000 customers with monthly recurring revenue of $3 million. What multiple can we expect? Everybody should have this problem, the same question.
Believe it or not, we've looked at a couple in the last few months that were that size with that many customers, and they had horrendous attrition rates, mainly because they expanded into geography where they couldn't provide service to their customers. And I've seen those transactions go for horrendous multiples because their attrition was so high. You have to look at the underlying company and what the customer base is, what the profitability is of the accounts, and what their attrition rate is. You can't just say because a company is a certain size, they're going to command a certain multiple. In some of these cases, the banks were actually forcing them to sell because the banks were terrified. So I need to know more about the company before I can tell you what it's worth. If it's a traditional company with 7 to 10% attrition, there's a huge premium in the fact that you've got a well-run large company that's a platform, but you're seeing less and less of those these days. They're getting absorbed up into the ADTs of the world. And a lot of the guys that are out there with that size of an RMR base have done it by getting overexpanded and over their skis, so to say, and they're not getting the multiples that they would think they would get.
Yeah, but I would add to that, if you got a quality company, and Mitch is right, obviously, if you got a lot of problems with attrition and service and all of that and have bad records, that all plays into that. But assuming you have a standard kind of attrition rate of 8 to 10% and you have that kind of base, I would tell you you're looking at a 45, possibly slightly higher. You're not going to break the 50 multiple unless it's very, very unusual. But I think certainly with a $3 million RMR, you're talking in the 45 range.
I agree, Dennis, and you obviously have not remembered Richard Gere from the movie Chicago, because this kind of question invites razzle dazzle, my friend. So yes, we're gonna get you at least 42. I would think that's the minimum you'd be looking at. And listen, you make the right deal, you might break 50, you might break 60. This is a nice sized company. Don't forget the questions set it up. It's a clean, large company. So clean means you've got my contracts. Clean means you've got your own lines. Clean means you have everything done exactly right. Does it matter if monitoring accounts are prepaid annually or quarterly? To some extent, it does, and there's certain a payment made for post-closing period is going to be deducted from the purchase price paid at closing.
Well, I was going to say annual can be a problem on many levels, but especially on the deferred. We had one company, nice mid-sized company. They billed everything annually in advance, and we were getting close to the closing when they the buyer came up with a preliminary purchase price calculation, and because of the annual in advance, which was spread out on anniversaries of the contracts, it wasn't it wasn't a December 31 kind of deal. Because of the hit they were going to take on the deferred revenue, they walked away from the deal. So annual at one time used to be very popular. Now you don't see a lot of it, but annual does have a negative impact on what you're going to get paid at the closing.
When I've had annual, the guarantee generally reads that the buyer receives at least one check from the subscriber, so that we know that they're going to get at least one payment from them. Listen, I want to thank Mitch and Dennis. These are two giants in the industry, both having been recognized by Securities Sales and Integration as for their lifetime achievement, and they're both in the Hall of Fame. They've given up their time this morning to give you this webinar, and so I want to thank them, and I want to thank you for attending. And we're going to see you the 24th. We're going to have another webinar. It'll be announced shortly on risk management, offered by one of the carriers that's prominent in the industry. And so I want to thank everybody, and we're going to sign off now, and see you next time. Bye, guys.
Goodbye.
All right.